Hello, this is the Unemployed Value Degen. I'm here sitting down with Mitch. How are you doing today, Mitch?
Hey, I'm doing great. Thanks for having me. How are you?
I'm doing very well. Um, I hope you had a good Christmas. Um, let's see, we're close to the end of the year here, and I wanted to spend a little bit of time just looking at some of the big patterns and trends and trying to figure out what's going to happen going into January. There's a little bit of fear out there, and I think this fear is surrounding this 10-year Treasury, which has not been well behaved. I've been drawing this channel, and it did not behave in the channel. It broke right out of there. The dollar is strong, the 10-year Treasury is high, and if we don't come back into this channel, and we've been outside of it long enough now, then the odds of getting to a 3% 10-year are rapidly diminishing. And if there's no 3% 10-year, then there's no 5.5% 30-year mortgage. And if there's no 5.5% 30-year mortgage, the whole idea of the economy just having this massive, melt up in maybe not the stock market, but the economy, where people do cash out refinancing or home equity loans. That whole thesis could be out the window if the 10-year Treasury doesn't start behaving itself. So, what have you been hearing in your industry, and what are your thoughts?
Yeah, all I'm hearing is fear about, the 10-year rising, especially, considering that interest rates have been cut 75 basis points since September, and the 10-year's gone up nearly 100 basis points.
Yeah, the
That's pretty counterintuitive to what you'd think. And like you're saying, the real estate market softening up, and M&A and all sorts of things are going to get impacted. If these rates can't actually stay down, the bond market isn't convinced that inflation is done, and I would agree with that. I think all sorts of signs of inflation still being present are here, and less rate cuts in 2025 might not be good news for the market.
Yeah, well, I think the market's already come to terms that there's, maybe a best case two rate cuts. We're still in a global central bank cutting cycle. Canada's already at a benchmark of, I think, three or three and a quarter. Europe is a whole percentage and a quarter below us. And globally, we're in a cutting cycle. The Chinese 10-year Treasury is 2%. So the Chinese is 2% and ours is 4.6. It seems like we have some room to come down. And the market is sharing that fear. So you go to the fear and greed index, and we went from being, solidly into greed, and then
Yeah,
smacked back all the way into, it wasn't quite extreme fear, but it went pretty close into fear. But I had,
yeah. The Trump rally was really something, and everything's been coming down since then.
yeah. So the Trump rally, at least let me go to I don't know, is it even still there in the Russell? So there's November 5th.
Barely.
And the small caps have almost completely retraced the Trump rally. Now the S&P 500 is above the Trump rally, but most of that is due to this the Magnificent Seven, right? The Magnificent Seven, it just only goes up. It's kind of amazing how it behaves. But if you want to look at IVE, is the value ETF, so the S&P 500 value, and that is solidly below that November 5th election. So value has had a huge sell-off. There's another, I'll do the RSP, the equal weighted, and this is just the last 3 months. Yeah, so the equal weighted is struggling. One of the best visualizations of this, it's just, this is the month, 1 month, what do they call this quadrant that Morningstar puts out? Large growth for the last month is up 1.25 or 1.4%, almost 1.5%. The entire value spectrum, from large to small, and the entire small spectrum, and even mid cap core. I mean, the farther you are from being the Magnificent Seven, the worse you've done. It's like there's the Magnificent Seven, there's everything else, and it's just pretty fantastic. And it's yeah, wow. I mean, what do you say to that? You either buy Nvidia at, I mean, what is its price to earnings at now? It's absurd. So do
Yeah,
you,
it's ridiculous.
when you're confronted with this, do you just hold your nose and buy Apple? I mean, I can't do it, but I have a suspicion that this trend is going to reverse when you get into when you get into January. People can start taking some gains and have a whole year before they pay taxes on it. But in the meantime, this is just an incredible amount of pain. And
Yeah, large cap growth, the Mag 7 is really, what investors are turning to when they're getting defensive rather than even, the large cap value that, typically is defensive.
yeah,
So it's an interesting shift. It'll be, interesting to see how long that lasts and, eventually maybe they'll come down. But as long as, interest rates are high, they're still going to be earning a lot on their cash, like a lot of other companies don't have the ability to.
well,
So
it's kind of a new paradigm shift because it used to be that if you were afraid, you would buy Procter and Gamble and Colgate Palmolive and Campbell's Soup. Now, if you're afraid, you buy Google and Meta and Microsoft and Apple, which is so. And also, if people think interest rates are going up, well, they say, okay, those companies have a lot of cash, it's good for them. If they think interest rates are going down, they think, okay, the stock market's going higher, it's good for them. Right? If they think we're heading into a recession, they want it for safety. If they think we're going into expansion, they want it for growth. It's like, take your pick, but whatever the question is, the answer is just to buy large cap growth.
yeah, I think Microsoft, Apple, Nvidia, all make a case for being able to continue growing in 2025. So at some point, if you can't beat them, don't you got to join them, right?
No, that's not in my DNA to buy those things. But in 2024, the Magnificent Seven had earnings growth of 30%, and the S&P 493 had earnings growth of I think 4%. So there really was a huge difference in earnings growth. Next year, the analysts are projecting the Magnificent Seven earnings growth to go down from 30% to 20%, which is still a lot, but the S&P 493 is projected to have earnings growth of over 13%. So there is a good chance 2025 is a good year for a rotation out of the Magnificent Seven. But I want to go back to this 10-year Treasury because I did hear a theory that I think is pretty compelling, that the recent spike out of this trend line in December could have been caused by tax loss harvesting. And we don't usually think of tax loss harvesting in treasuries because we've had overall declining interest rates for 40 years. But if you look at the different sectors, for 2024, which sector are you going to tax loss harvest from? Because even, for one thing, no professional managers are really into energy ever since the ESG mandates came through. So you've got consumer discretionary, or it's up 13-14%. Where are your tax loss harvesting targets? Right, materials, really. I mean, even the poor performing sectors are up double digits. So how many tax loss harvesting targets do you have? Meanwhile, right, we started the year at a 10-year Treasury of, what is this, 3.9%, and we're at 4.5% when the tax loss harvesting started in earnest. So I think there's a chance that this recent spike up was from tax loss harvesting. And on top of that, because bonds fell this year, while the S&P 500 is up over 20%, the 60-40 portfolios that have automatic rebalancing, 60-40 has become 66-34. So they're going to have to
could be a
sell.
lot of rebalancing, buying into fixed income.
Yeah. There's going to be so much automated selling of the S&P 500 and buying of bonds generally that's going to take place in January. I think we could see a huge reversal in this 10-year Treasury price. I mean, I can't guarantee it, but if this spike is tax loss harvesting and the Treasury selling goes away as December ends, and if that automatic rebalancing has, hundreds of billions of dollars to deploy from selling the S&P 500 and buying bonds, this could have a pretty steep fall in the first couple of months. Now, I don't know that's going to happen, but I find that to be a pretty compelling theory. What are your thoughts, Mitch?
Yeah, I would love to see that happen. I'm not. I think it's a good take that this spike could be tax loss harvesting, but I think this is probably the top thing to watch going into 2025, because if it's not just tax loss harvesting and this continues above that first peak in 2024 that we have, it could be some serious problems.
Yeah.
So
No, this is
uh,
definitely what's got everybody clenched, on the edge of their seats and has this the fear index on fear. Um, but the interest rates differential heavily affects the dollar index, and the dollar strength that's broken out of its channel.
yeah,
Um,
it definitely has.
and even if, right, because there's two reasons why people are buying. Two reasons why people are buying U.S. dollars. And one is the interest rate differential, but the other is because people in other stock markets want to buy the Magnificent Seven. Europe does not have big tech. Asia has its own problems, but for the most part, all around the world, South America doesn't have big tech. It's been this constant stream of people selling their own stock markets and buying the Magnificent Seven in the U.S. And
I mean, if anyone's done that, I'm sure it's been working great for them.
yeah, well, so even if the 10-year Treasury comes down a bit, I think it's more likely the 10-year Treasury starts behaving in its channel. Excuse me, we've all come down with a bit of a cold here. I think the dollar breaking out of its channel, the upside, it could stay strong, and it could kind of permanently break out of this channel to a much greater extent than the 10-year Treasury. And let's see, can I move this down? Oh, no, I want that to be flat. I got to bring this one up. I got to move it about there. Yeah, I think the dollar strength, which and I don't think anybody really knows what Trump is going to be like in his second term, but in his first term, he wanted a weak dollar to help exports. But you have the United States now just as this enormous energy exporter. We have cheap electricity. We have the Magnificent Seven and the artificial intelligence revolution just on this incredible boom. And you have Europe struggling, going through several years of deindustrialization and recession. And you have South America, so Brazil, their biggest economy, with the socialists trying to destroy their currency. I don't see where and China's on a stimulating cycle, right? China's got a 2% 10-year Treasury trying to get out of their housing overbuild. So the U.S. dollar, it might frustrate Trump, but I don't think we're going to have a weak dollar. I think we'll have a strong dollar for a while, with ups and downs. But yeah, it's. I think international stocks. If I was going to bet what was going to mean revert first, value or small cap or international, I think I might look at value and small cap before I looked at international. Because I think there's a better
I
chance
agree
of
with you there.
yeah. But anyway,
I
that's
would
just
definitely expect some pro-domestic activity. It's hard to say what exactly he'll do, what's going to happen with tariffs, but I I think a strong dollar has a good potential for happening.
yeah. And I've been listening to the earnings calls of some of these equipment dealership companies, and one of the common themes is they've all said that they have customers that are just waiting for either a little bit of interest rate relief, or one other theory is that in January, once they're in calendar year 2025, they're so confident that Trump is going to be able to extend his tax regime, which includes heavily accelerated depreciation, that they might be pulling the trigger on purchases in the start of January, even before they're certain that he's officially extended the Trump tax policies. So there could be a pretty good chance for a lot of booming activity, but there are some reasons to be afraid. I think the one thing that's driving that fear is the 10-year Treasury, and I think it's going to come down pretty quick once we get into January. Alternatively, though, if we're almost taking out this past peak of 4.7 something, and after that it's a quick march up to 5, and that would scare an awful lot of people.
Yeah, 5, you would see a whole lot of fear in the market.
Yeah.
But that might be what it takes for the market to pull back really, and kind of create this, not necessarily a recession or anything, but the buying opportunity I think everybody's really been waiting on, because the market's just been red hot. So I wouldn't be surprised by some sort of pullback, maybe to the 200-day. That wouldn't surprise me.
So on the equal weighted S&P 500, we weren't that far from the 200-day. I mean, going from 172 to 170 on this equal weighted S&P 500 ETF, that's not a far
it got oversold
drop.
a bit and has been bouncing, but
Yeah.
could with a 5% yield, that could be trouble.
Yeah. And then, so that's the equal weighted S&P 500 ETF. We can look at the SPY. I mean, the big question is, and the S&P 500.
See, that would have a lot more room to fall.
Yeah. Because it's all the Magnificent Seven versus everything else. Because the value stocks, right? The value stocks were really spitting distance to the 200-day moving average. I mean, the sell-off, the 14 days straight down in value were extremely painful. I mean, this already is a correction.
That hurt for sure.
I mean, going from 205 to 189, you're talking about pretty close to the definitive correction, right? You're expecting within a calendar year 10% correction and maybe 5% corrections. Well, for value as a factor, we pretty much had it. And then let's see. But the one that keeps trudging along is that Magnificent Seven, right? That big tech. I mean, they barely touched the 20-day moving average, much less the 50, much less the 200. So
yeah, it's just been chugging away.
Yeah.
Doesn't matter how overbought it gets, just keeps running.
But if you look at the components, and I didn't think wanted to spend that much time on it. So you have, Apple at a price to earnings of 42, and not really projecting much earnings growth next year. So the upgrade cycle for their phones, people are waiting for AI to actually do something on their phone, and that's not here yet. So Apple has
but I mean, there's been AI on phones for however long iPhones have been around with Siri, and you can already get, say Copilot or Gemini or whatever apps on your phone. I don't know how much of a difference it's going to make for Apple once they have their, Apple version AI built into phones. I think the people who want to use AI on their phone already are able to.
Yeah, but Apple has no big phone replacement cycle in front of it to generate revenue growth, and they've got these headwinds now in China, as the Chinese are buying fewer Apple phones. So you're at a price to earnings of 42. That's a tough sell for me. Although Costco's at a price to earnings of 50, Microsoft's at a price to earnings of 35. But this chart is struggling a bit. Let's see.
Yeah, I mean, to me, it looks like it's just been consolidating. I don't, necessarily think it's been struggling when, so much of the market has been falling.
Google, you've got, price to earnings of 25. I think Google has some room to go. People thought that they were going to be one of the big losers of artificial intelligence and lose their search monopoly. But now they've had a bunch of home runs with some of their so they have all these incubator companies. Some of those are AI focused, and now some of those can be spun off for billions of dollars. So Google might have some room to run, but you also have I think it's still a real possibility. I don't know if it's going to happen or not, but there's still a real possibility that when the Republicans have all three houses, they might want some retribution for how some of these companies have been affecting influencing elections. Like the Google search terms, there's been a lot of academic papers on, during an election, you search for the Democratic candidate, these are the results. You search for the Republican candidate, and then these are the much, much worse results. And that equates to billions and billions of dollars of illegal campaign finance support, I just have a hard time believing that with the Republicans having all three chambers, that they're going to get away with this stuff scot-free. You have, in the last election, Zuckerberg gave $400 million to do these, in the 2020 election, to do this vote tabulating centers. But they just mysteriously only were operated in the most heavily Democratic voting counties. And it was, again, very easy for a Department of Justice to go in and say, no, that was $400 million of illegal campaign finance and you need prison time. So I don't know if this new Trump administration, allied with Silicon Valley, with Peter Thiel and J.D. Vance, if big tech is going to get away with what they've been doing for years. There's Meta at a PE of 28. I could see Meta rising higher. I could see Google rising higher, unless the Trump Department of Justice really starts coming after these things. If you were going to take some profits in January, what would you sell?
Oh, sorry. What was that last thing?
If you were going to take profits in January, what would you sell?
I think, as much as our bias as, small cap value investors, I think you'd have to be a fool to sell the Mag 7, right? Even though I wouldn't buy, there's just going to be so much passive money coming into these through ETFs and indexes that, the continued strength and momentum, I don't really see coming down. I have heard some negative takes on the real estate market, though, housing development. So I think, if you go back to that quilt of, all the stock returns for the sectors, they were near the bottom. I think that might be where, especially if people are being cautious about treasury yields, I think real estate could be another area that, people are tax loss harvesting.
Yeah.
Because a lot of those stocks have been down.
Yeah, real estate investment trusts have been doing pretty terribly. A lot of times, especially with so commercial real estate, just because that's connected to office, you have to think of commercial without office. But industrial and commercial real estate, the lease terms tend to be long. So with that big inflation surge, you don't get that increase in rents quickly. So the yields on the real estate investment trusts haven't kept up with that big inflation surge if you have these long-term fixed lease contracts. So I find it kind of interesting that especially industrial REITs have really lagged behind the market. But
yeah, I would have thought with interest rates coming down and all these beliefs of nearshoring and domestic industrialization with especially under Trump, I thought industrial REITs would have been doing better, but that's not really so much the case.
Yeah.
What I do think is poised to do well in a high interest rate and high inflation economy is financials.
Yeah. Well, part of that is because we're out of the negative yield curve. So the negative yield curve with the banks that pay the overnight rate to their depositors, well, they pay much less than that, but then they lend long term for mortgages. So the yield curve's only just back to flat. It's not even positive yet. But it's just back to flat. But financials really outperformed in the last couple of months here. I don't know how much of that they pulled forward. There's a lot of people saying financials could be the best performing sector next year. I'm this energy with two years in a row in the bottom of the pack, and I go back to this dollar strength. Crude oil stayed at $70 a barrel as the dollar ripped higher. Oil is already $100 a barrel in Canada. So I think there's been some real stealth energy strength that people in the US are missing because it's been hidden underneath this massive rally in the dollar. For the price of crude oil to still be 70 in the US after this massive rise in the dollar is really this oil strength under the radar. So I think energy could have a good time next year. For energy to really do well, professional managers have to buy it again. So the whole ESG mandate would have to slowly get broken. I don't know if we're there yet, but
yeah, I think we started to see the start of ESG, starting to go away with Larry Fink kind of denouncing it.
Yeah.
So hopefully we'll see, some more to follow on fund managers not, considering ESG so heavily.
Yeah, it hasn't turned on a dime, because sometimes it's baked into the mission statements, but it's definitely starting to get scrubbed from a few places. Last time we talked about consumer discretionary, it had been doing better than this. I think consumer discretionary sold off a little bit in this recent collapse, and it makes me even more convinced that, and also um, a huge chunk of consumer discretionary as a sector. You have the weights. I think there's two of the Mag 7 components that are in consumer discretionary. Is it Amazon and Tesla both?
Yeah, I believe so.
So this consumer discretionary is only up 13%. And I think like 30 or 40% of the weight of it is Amazon and Tesla. So the rest of consumer discretionary have really struggled. I think there's a good chance this could bounce back pretty hard in 2025.
Yeah, I agree with you there. Except, the high interest rates and high inflation could pressure the consumer,
Yeah,
pressure in disposable income.
yeah.
So that's something to watch out. I mean, it could have, another low year or, middle of the pack sort of year. But I think it eventually will rebound.
Yeah, well, I might be early. It might be a 2026 thing. I mean, what would give the consumer some relief? It's been a very slow grind for real wages to try and retake some of what was lost during the COVID lockdowns. But then you had rents really rocketing higher when we had 10 million people walk across the southern border. And a lot of this stuff with Trump, it's going to be devil in the details. But I think there's, J.D. Vance was talking about anybody with a criminal record, they're actually going to send, the Migra after them and really round them up and actively deport them. But the other, however many millions are here in the country, we don't even really have a good count. I looked at some back when I was in a master's program for economics. I looked at some of the peer-reviewed papers, and even the experts admit that they could be 10 or 20 million people off as far as how many people are in the country illegally. The rest is just making it uncomfortable for them to be here. Saying there's no more handouts, no more welfare, no more rent assistance, no more any checks from federal, state, or local governments going to people who aren't supposed to be here, and see if they would just go home on their own with that. And they can also go after the employers. They can make it painful for employers that are hiring illegals. I think that's a potential avenue, but that would be maybe bad for real estate because you'd have falling rents, but that might be really good for the consumer. So it's going to depend how fast any of that can happen. It's going to depend how serious anything, because there's been a lot of campaign promises, but my default cynicism is that nothing ever happens. So we'll have to see how it all materializes.
Yeah, I think, like you said, the devil's in the details. We'll have to see, who he's really going after, how effective it is, and yeah, it's hard to really, have a pulse on what's going to happen because so much changes by the time anything actually gets done.
Yeah. Well, why don't we go ahead and jump into some individual names and look at some charts, because there are there's been some strange behavior with the recent sell-off in December. With only most professional managers have got to be on vacation by now. I think there's going to be really thin volume going into the end of the year. I think most of the tax loss harvesting is done. We're going to see what happens in January when people come back. But I wanted to look at a couple of the smaller names that are much smaller positions in the portfolio. FTC Solar. I had written about them about 6 months ago, and I kind of warned that there would probably be, I think it was closer to about this area in the summer, that there was probably going to be a couple of bad quarters because they had this huge backlog, but that backlog, nobody was actually going to instigate a project. So these projects, the start date were not as fixed. Like they had been awarded the work, but construction hadn't begun, and construction was going to begin whenever the project developers want it to begin, and they were holding off for lower interest rates. But meanwhile, their backlog has grown, so the CEO has been out there selling this company and landing new projects, and also doing some insider buying, so that Now they did raise some debt. It might have even been convertible, some dilutive debt, because they needed cash to fund their backlog and actually get going. But it had this massive rocket upwards just in the last 2 or 3 days, in the middle of all this tax loss selling. I think it's on insider buying, increased backlog. I think the story might be getting discovered. But this is just on the technicals. I don't know what to make of this massive spike, and then also retracing halfway through it on one day. But it was a huge spike. Do you want me to zoom in on that a little closer?
Yeah, I mean, even from there, I can see, it. So for most of December, it looks like it consolidated a bit at that $3 range, and now it moved back up, and the RSI is getting pretty hot. Looks like it's nearing 70. But if the stock could bounce off of the 50-day and the 200, and the 50-day stays on top, if it could hold that, it could continue to rally. The next area of resistance I would look towards is around 7, where that double top was. I
Yeah.
wouldn't, the peak of this rally didn't even get there. So this is an important level to watch. Is it going to hold above or below the moving averages? And either direction will give you, a sense of where the momentum's going to take it. Is it going to go back up to 7 or back down to 3? Right.
Yeah.
So at 5:30, I think it probably isn't something I'm rushing to buy, because might come back down to the moving averages. But yeah, it does look like it's breaking out of this that bottom support that it was building. So yeah, just seeing whether or not it could stay above its moving averages here, I think, is going to be the key point.
Okay, interesting. Yeah, I kind of hadn't been paying attention to every individual position for the last couple of days, and I missed this massive breakout, but that was a huge move in one day.
Yeah, that's giant.
Yeah. See, I wanted to look at some of the smaller names in the portfolio, if you're okay with that.
Yeah, sure.
One is so Douglas Elliman. Douglas Elliman had really, especially with the rising interest rates, right? They've been crushed. Even before the sell-off of value in December, it's all with this rising interest rates. They're back down just about to the price they were when they replaced their CEO, and just the part of me that likes to catch falling knives is finding this really attractive. But I was curious about your take on it.
Yeah, this looks like it might have a little more room to run, mainly based off the fact that it has just fallen under the 200-day moving average. I think it could, continue to trade below for a little bit, and I would personally want to see either the RSI getting oversold, which it's nearly there, but it hasn't quite hit that yet, or it maintaining above the 200-day. But yeah, this is some really strong selling momentum. Might be early on the falling knife.
Yeah.
But it's a good company. But kind of back to what we said about real estate companies potentially struggling with higher interest rates.
Well, what's amazing about this one, though, is to be the premier real estate broker handling like the high-end luxury condos in Miami. This is even a stealth crypto beneficiary, because when somebody wants to take 10 million bucks out of their crypto wallet and buy a condo, that's going to be Douglas Elliman volume. So they should be the least interest rate sensitive of all the real estate brokers. Just it's a super high end, and also the stock market, right? If you have, however many millions that you've made in the Magnificent Seven, and it's time to go buy a property with it. So anyway, I get what you're saying with the technicals.
If it consolidates here at this $1.50 range, it still could be higher highs and higher lows. It could be, a significant uptrend since July still. That might not necessarily have been broken, but we would need to see some consolidation and some relief, here. But I think there is significant risk to, this chart breaking.
Okay. Now, one of my first big paywalled write-up successes, Finance of America companies, it's been getting a lot of attention. A lot more people have discovered it. A lot more people are talking about it. And what do you think about the price action this last month since we looked at it last?
Yeah, I mean, this thing just goes up with, people are finally starting to figure out the story with book value increasing like 10, $10 a share or something last quarter, something ridiculous. It's starting to pick up action, and it's hot for sure, but this looks like, it's not showing any signs of why this rally would stop. It's not, overbought yet,
Yeah.
and it's still above, the last peak that it had, or it's right about out there, and it's moving averages, still looking bullish. Could it fall back to its 20-day moving average, that dotted line? Yeah, possibly. It's a very volatile stock, but if you look back over this chart, it's pretty well behaved on the Bollinger Bands and the 20-day in the middle.
Yeah.
So I think that is a good point to watch for them.
Yeah, I mean, since it broke out of the $5 range, it has been not even going that far below the 20-day average. When it falls, it really, especially here, it's been really well behaved on the 20-day moving average. So yeah, and my concerns about this one would be the way that the residuals come in. I don't know if it's going to be smooth, if there's going to be positive results every quarter, if there's going to be a quarter where it's, hey, last quarter the book value went up by 175 million. How come nothing happened this quarter? And then the convertible debt converts at $27.50. So I think the price could end up getting pinned there for a while.
Yeah, and if it did, I don't think that would be the worst thing. It might, very volatile stock. It might, dip below. It might, do a whole lot of, choppiness for a while. But
Yeah.
I don't really see a case for this being a $10 stock again.
Yeah.
So if it dips, I think that's an opportunity, more so than anything.
All right. Now, let me look at some of these equipment dealership leasing parts and services businesses. Alta Equipment Group. That's an ugly chart. But again, it's all that sell off in value since December, and that everything
Right.
got sold off together.
Yeah, that hit a pretty hard double or triple top right there, and between November and December, and failed to break out above the 200. So that's me, especially with it now, under the 50-day, you know, it seems like this might be going lower.
So
It's
these
failed
periods
three.
where it tries to get above the 200-day moving average and it just can't stay there, or it can, this thing
Right.
couldn't
That,
even reach it.
as you've seen from those last three, it's been a recipe for the stock to go lower when
Yeah.
it fails to break out. So it wouldn't surprise me if that was to continue.
Okay. Very fair. And it's also going to be interest rate sensitive. I mean, the fundamental shock here would be if come January all of their customers start coming in because they want that accelerated depreciation. And interest rates, I mean, a 4.6% 10-year Treasury, that's just historically normal. I know people have to get accustomed to it again because we didn't have it for 20 years, but it's still, a historically normal thing. This is Custom Truck One Source.
Now, this looks interesting to me. It's, it got overbought. It bounced back down, retraced to its, 50-day and 200-day. Now it's sitting there, consolidating a bit. You still have the golden cross going on. Chart's not overbought. It might dip below, but this is looking like, it could be setting up for a continued breakout. I
Okay.
like this chart.
So the 50-day and the 200-day, the 50-day cross the 200, that's the golden cross right there,
Yep.
which took place in December. And then this is a strong area of technical resistance because pretty much everything's happening in the same place, the 50-day, the 200-day, and the lower Bollinger Band. It's all right here. So if it broke below this, there's no other support, but odds are pretty good here that it could bounce, especially as we go into January and people look to rotate.
Yeah, I mean, sometimes you'll see it dip below both moving averages, and that ends up being, the peak time to buy. But it's not always worth it to try and catch the very bottom,
Yeah.
So I think this is a decent place to buy.
Okay.
What
And
about
then
that TWI stock that
yeah,
you wrote up about? I like the sound of that one.
yeah. I started a position in this one. The I mean, this is kind of a maybe a quadruple bottom. Um, well, that doesn't line up exactly as well, but uh, I don't know. What do you think of that one? It's still pretty far under the 200
Yeah,
day.
it looks like it's consolidating to me. It had that failed breakout where it, tried to go above the 200 and then right back down to that resistance. But it does seem to be holding that, call it 670 level pretty strong. Yeah, from there.
Yeah.
So, um, it might be around its bottom. It might, I wouldn't be surprised if this had some more consolidation before really moving anywhere. Maybe making another attempt at crossing the 200. If
Okay.
if it can rally and get a golden cross, this might be a really good technical setup. But
Okay.
as of now, doesn't look like it's the most attractive thing to buy.
Okay. Heartland Express. That's looking pretty ugly.
Yeah, that's not looking too great. You'd hope to catch a bounce here with it being, just coming off oversold and nearing your support from the last bottom it had in November.
Yeah. I mean, all these charts, they're almost identical. From the start of December, from the top of the range to the bottom of the range, has been
Yeah,
enormous
it's almost
selling.
gone down.
Yeah, but I mean, everything did that except for the Magnificent Seven. That's Heartland Express. Let me take a look at the two biotech stocks, which are SPRY.
Oh yeah, they've pulled back. I'm actually, strongly considering buying some at this $10 level
Yeah,
because
because
I think, fundamentally it's gotten the story's just getting better, and I think it's just fear in the market, and maybe it pulling back. It hit oversold a couple of times, and now it's nearing. I mean, oversold now. It hit overbought a couple of times that it's recovering from. Now below its moving averages. You got some decent support there around 9. Maybe at $9 it'll be a little cheaper and better of a buy, but who knows if it'll fall that far. I
so
think it's a quality company that I wouldn't mind buying the dip of.
so as far as if it was gonna catch some technical resistance, this area that
Yeah,
had been
it'll probably be around that area if I had
okay.
to guess.
So that's likely the best bargain you could hope to get is something just around $9. No
Yeah,
guarantee it'll
but I
fall
mean,
there.
right now it just bounced off its bottom Bollinger Band, so we'll see if that's strong enough
Yeah.
support, or if not, maybe expect it to go a buck lower. But I'd be unloading the cash at 9.
Yeah, and this one you can see. I mean, the sell off started even with the election because it was RFK Jr. is going to come in and wreak havoc in biotech, but
Yeah, but
they
they're already FDA
yeah
approved.
they have their patents, they have their FDA approval, and
Yeah,
also
it's throwing the baby out with the bathwater.
yeah
It's I don't think they're going to be too negatively affected.
yeah I think so. I think that's pretty. I think this is a pretty good setup, and I'm not great at biotechs. I haven't written about too many of them, but I like this
Yeah,
one
it's
a
a
lot.
hard one to be confident in, but especially being past FDA approval, you have a pretty good idea what you're getting into. Wow, that's a major sell off.
Yeah, well, I wrote about this company. I don't remember what the price was when I wrote about it, but it was in this not in the $12 range. I wrote about it after in the $3 range because there was insider buying. So yeah, some of this is the RFK Jr. healthcare sell-off, and then on top of that, you have the December sell-off. So as much it looked like it was going to try and retrace some of this collapse, and then you had the
Yeah,
value
and it
sell-off.
just failed. That does not look like a setup I want to get into.
Yeah,
Since falling, it hasn't immediately recovered. It's had lower lows and lower highs.
yeah, it hasn't
So
had time to really give much of a new pattern.
yeah, this looks like it's gonna best case, consolidate in the 3 to 4 range. Worst case, keep going under.
Yeah, and then there's Portillo's.
Oh yeah, that's been a nasty sell-off.
Now this one, I don't know why this sell-off started in November, but then it did have, it was bouncing back from that, and then there's this December value sell-off for 14 days.
Yeah.
But so I don't know fundamentally what's driving it. I had a couple of puts assigned to me, so this ended up being a lot of my December buying. I accumulated some Portillos, but I still love it, and I think they're opening 4 locations this quarter, most of them in Texas. And one of my subscribers on Substack went to one of their new location grand openings and said it was amazing.
Yeah, I think, there's still potential for this one. It looks like, the bottom potentially might be in. It got oversold, and it's, consolidating a bit. It did hit this level, in August with that low. So I hope that the bottom's in, but
Yeah.
it might consolidate in this range a little further. You've got, a bearish crossing of the moving averages that, I would stay aware of.
Yeah, so
But
that's the death cross, the 50 below the 200.
right. But if this is the bottom and starts to rally, that could, easily, revert. So this thing has had a pretty nasty sell-off from 14 and a half down to 10, so even below that. So this is something I like, but I would definitely want to see it hold this level. If it goes any lower, there's no more support.
So there was only one chart you liked outside of the Magnificent Seven, and that was Custom Truck One Source. And but ARS Therapeutics, you like that more in the fundamentals than the chart, I think.
Yeah.
So looking forward for 2025, out of all the stuff in the portfolio, what are you the most excited about for next year?
Oh, that's a great question. Oh man, I would love to see maybe Vermilion vet start to turn around. I think they have some decent possibility, and yeah, they're sitting at a triple bottom right now too.
Yeah. Well, and
Uh,
there's a lot of Twitter meteorologists, for whatever that's worth, that think that we're going to have a pretty cold winter with the polar vortex coming. So natural gas prices are up. And then also back to this idea that oil is $100 Canadian. Their employees' salaries don't go up just because oil is $100 Canadian. I mean, they get to the benefit of this more expensive oil price without the increased costs. So they're selling natural gas for good prices in Europe. They're selling oil and natural gas for better prices in Canada. The market didn't love their recent acquisition, but compared to Peabody Energy, I mean, Peabody Energy, the market absolutely hated their acquisition. So, and I wrote about both of them and said, Vermilion's was better on a relative basis than Peabody's. It's after 2 years, after being in energy for 2 years and having it not working, I'm so cautious with my optimism. I'm not even allowing myself to get excited for this one. I'm not selling, but I'm not allowing myself to get excited.
yeah, I know this one seemed like a fat pitch for quite a while now, but it's just done nothing but go down.
Well, and what's amazing is they retired $1 billion of debt and the stock price only fell, right? And then they added $1 billion of debt, but now increased the size of the company by 40%, and the stock price stayed flat. And they've retired, I want to say it's something like 15% of the float during this time, and the stock price has only fallen. I mean, your stock price doesn't go up on retiring $1 billion in debt. The stock price doesn't go up on retiring 15% of the float. The stock price doesn't go up on a huge acquisition. It's just energy stocks don't want to go up.
Yeah, because no portfolio managers are buying them.
Yeah. So,
But
well,
something I haven't heard you mention in a while is Riley.
oh yeah. So I stopped talking about it because uh, so it's a messy one. Um, it's been in this sort of either consolidation or slowly grinding lower situation. They haven't released a 8K for a couple quarters now. So there have been some positive things going on under the surface. And mostly I stopped talking about it. I just didn't want I felt that the risk reward profile of it wasn't suitable for my Substack subscribers. I still own some. I still have a few puts sold. I still like it, but I don't talk about it on my Substack anymore. So their large lender, Nomura, asked them to massively shrink the size of their loan. They wanted Riley to get down to I think their loan was, I don't know, something like $600 million term loan or something like that. And they wanted to get it down to $100 million. And Riley is pretty darn close, I think, to hitting that target. So they sold half of the Great American Group to Howard Marks at Oaktree for a couple $100 million. They raised, and I didn't think this part of the company had any value at all, but they had this little tiny public ticker called Bebe, which and they were able to get $40 million out of that somehow. So they've made a lot of progress toward deleveraging. They're going to hit a point where the rest of their debt is fixed with these baby bonds that nobody can call on them. But the problem is, because they're a trust-based institution, because they're in the capital markets, their reputation really is a huge thing about how they can generate new business. And these short sellers write 100 times a day on Twitter that they're all a bunch of frauds. And that has significantly hurt their ability for their core business to get new business. And they've even had a couple high-profile executives leave. There's even a lawsuit relating to one of them for, I guess, stealing clients or something like that. And the reason they gave is, look, we can't get any new customers if there's this cloud of somebody on Twitter calling you a fraud 100 times a day. And the person doing it has a pretty serious reputation as a short seller. But after having dug into the company so much, my personal opinion is the most likely thing is this is not a situation where these are bad people and he discovered a mispriced security. This is a situation where a short seller actually can destroy a company because they're reputation based, and he can destroy their reputation. And our defamation laws are just not up to fighting against this sort of thing. But there is a chance.
So you think this is something worth holding on to then, if there's so much risk?
Yeah.
I mean, the market cap of 140 million is nothing.
So their apparel brands, their laptop case company, and their telecom company combined is worth way more than that, and can easily service the debt once they get out of their Nomura loan. And that's not capital markets related, so the reputation has nothing to do with it. I mean, the reputation has nothing to do with how people pay their cell phone bill. So I think there's still a lot of value there. A lot of value was lost when Franchise Group declared bankruptcy. So the one nice thing about their structure is their variable cost management. A lot of their investment bankers, it's kind of an eat what you kill strategy. The bad thing is it means they're not earning much money if they can't land any business with the reputation problems. But the good news is that they have very good cost control. I have it on a wait and see. For what it is, the price is just so cheap. I think, we could easily find out that the founder and chairman and co-CEO retires, changes the name of the company, and kind of washes away the reputational stain with it. That could, cause this to be that could cause this to be a 4 or 5x overnight if they can start getting volume again. So anyway, it's I haven't sold it. There's again with their core business, I don't know what percentage of that. So some of the core business is capital markets, but some of the core business is things like appraisal and consultancy, and that stuff is a lot less destroyable through the reputation than underwriting mergers and acquisitions and things like that. So it's the risk reward is not good for my Substack. I still like it with their portfolio companies that they've acquired over time. They still have a lot of value there, but it does have a lot of risk.
Interesting. Well, I think that's all the time I've got today, but thank you so much for having me on.
No worries. Thank you for coming, Mitch. I really appreciate it.
All right. Have a good one.
All right. Thanks. And I'll let you go. And for everybody else, this is the end of year analysis for the Unemployed Value Degen. I was joined by Mitch. This is not financial advice. And thank you guys for coming. Have a good day.